Hello, everyone, and welcome to Open Source in Business, a speaker series where we explore the breadth and depth of open source technology and its influence on the industry at large. And today I'm joined by Astasia Myers of Redpoint Ventures. Welcome to Open Source in Business, Astasia. Thank you for joining me.
Well, thank you so much for having me, Dave. Welcome, everyone. My name is Astasia Myers, and I'm an enterprise investor at Redpoint Ventures. Redpoint is a 20-year-old Silicon Valley-based VC firm with a long history of investing in some incredible founders like those at Snowflake, Twilio, Customer, HIMS, Pure Storage, among others. Our firm has been investing in open source for over a decade. It really started with our first investment in Zimbra, which was an open source email client. And since then, we've partnered with numerous companies in the space like HashiCorp and SourceGraph and CockroachDB. Open source startups are a key focus for our team, and I personally work with a handful of open source startups today, including Solo.io. At Redpoint overall, I focus on solutions that sell into technical audiences like big data and machine learning, dev tools and infrastructure, and cybersecurity. I joined from Cisco, where I was on the M&A and venture investing team, looking at technologies in the DevOps and infrastructure space. And before that, I started my career in sell-side equity research, covering publicly traded IT networking and security companies like VMware, Cisco, and Palo Alto Networks. I also write a lot about open source trends and technologies on my blog, Medium blog, Memory Leak. So definitely check that out.
Thank you. So I'm sure that a number of our audience will be interested in how you think about open source companies in general, and I'm sure we'll get into that later. But can you give me just an overview of what open source companies you have in your portfolio right now, and like what type of industry sectors does Redpoint invest in, and are there industry sectors where you see more open source?
Yeah, great question. So currently we have about 15 active open source portfolio companies and a few more companies that deeply leverage open source as part of their architecture. I mentioned some of our portfolio companies just a moment ago, but others include Return to Corp, R2C, Coder, Bitwarden, and some of the companies that leverage open source as part of their infra deeply are like Dremio that uses Apache Arrow, and Iceberg, and Cyril, which uses OPA, both companies that I work with. What we mostly look at is open source in the context of enterprise or B2B solutions. While there's a burgeoning industry of open source applied to consumer technologies and financial services, most of our portfolio today is B2B. It's really cool because since we've been investing in the space for so long, we've kind of identified some common factors between the open source companies that we've partnered with and those that have become successful. All enterprise businesses have a few things that we look for. Is the technology, really solving a key pain point? Is the software easy to implement, use, and maintain? Does it provide a delightful customer experience? These are, first principles for any type of investing, particularly enterprise, but something that's really important for open source led business models is the ease of implementation. We really look at, can you get up and running as a user within 30 minutes and have time to value in a really short time horizon? Are you writing an open source project that's in a common language so that you have a large user base that could come and use it, like Go or JavaScript or Python? And really, is the open source enabling you to simplify a really complex problem or workflow that makes it easy to adopt? Something that's also a little bit different about open source than traditional enterprise startups we look at is the role of community and users really early in the company's life cycle. Companies that open source startups that do a really good job of engaging the community, listening to them, and becoming a trusted partner to those users in the context of their solution, but also the ecosystem at large, tend to perform much better. And so for open source companies, typically, even when you get to about 2 pizza teams of engineers, you start to look for a DevRel leader to help with that engagement in the community.
So in general, you'd see companies in open source hiring for that community development or developer ecosystem development very early in their life cycle, much earlier than traditional enterprise?
Yeah, we typically see that developer relations or evangelism is a key role early in a business's life cycle. Some of that is because with open source, it's a crucial distribution model where you can get traction globally quite quickly. And it's really important for those users to understand how to use the product, understand how they can grow the product within their organization so that it's a key piece of infrastructure, and community relations are imperative for that. Typically with open source businesses, you actually hire your DevRel leader even before a salesperson, because really the intention is to be an educator and to build trust with the user. And it's not about the sale, it's about ubiquity of the product and the delightful user experience.
So it's about using the open source project as something of a wedge to grow a potential market that you can later sell into with complementary products. Is that generally the way the dynamic works?
Yeah, it's really about just the ubiquity of getting the software out to the users, making sure that they understand it through education, adopt it rapidly, and grow within the business. And it's only later that you really think about monetizing your customer base.
So that sounds like it's particularly focused on open source product companies, like companies that are selling a product based on a successful open source project. Do you see in the other companies in your portfolio, do you see a lot of them releasing components of their internal development tools or parts of their software supply chain as open source, just as a cost optimization or as a way to establish a reputation, reduce cost of getting new employees, whatever the reasons are? Do you see, like, how broadly would you say there are companies in your portfolio that don't use open source as part of their software supply chain right now?
Yeah, that's a great question. Well, I think it'd be pretty hard to find a company in this day and age where open source is not a huge component of their software stack. I think there's some stats out there that over 85% of software that's being built today uses open source. What I was thinking of to your second question is, are there businesses that we work with today that contribute back to open source or are kind of the stewards of open source projects, which they may not be commercializing completely? So a great example of that is Dremio, which is a data virtualization solution that leverages Apache Arrow and Iceberg. They're heavy contributors to that solution, and they want to make sure that it's ubiquitous across the industry as a standard. Another one is a business called Cyril, which is a data security and access control company I work with. And they have, since it's access control, a large component of that is authorization. And so they contribute back to OPA and have their own other project that's open source that uses OPA, kind of demonstrating their knowledge of the technology and making it more widely adopted for others.
So there's, like you also mentioned before we came on air, Solo.io, who are obviously big contributors to Istio and I don't know if it's Istio or what's the name of the project?
They do a lot. Envoy and Istio, they're very large contributors too. Yeah, they're quite active in that community for sure.
Envoy,
and they've also they launched their own like OSI, which is like an open source service mesh integration layer, so that the service meshes can be more compatible themselves. So yeah, you're totally right. Solo.io is heavily involved in open source.
So in general, I imagine that a lot of the criteria that you take into account for an investment decision are going to be the same, whether your company is open source based or not.
It's similar. I think for us, it comes down to that we evaluate startups around 4 different buckets. 1 is really the team, 2 is the product, 3 is the market, and 4 is the financial and user performance to date. The weight that we put on each of those depends on the stage of the business, seed versus Series D, and the sector that you're operating in: enterprise, consumer, financial services, healthcare. At the earliest stages, we anchor on team first. We want to really make sure that people have domain expertise, leadership capabilities, and kind of grit. If you go later, you emphasize a little bit less on team, simply because at that stage, there's pretty good track record of performance of the management team. So even if they maybe don't come from the category, they've proven their aptitude and their success. So it's a little less weighted the later you go. And there is some difference in an enterprise technology we look at that's closed source versus open source. So some of the details that are important for us is the founder of the open source startup the creator of the project and have influence over that community? Do they have an asymmetric insight into how the architectures are going to evolve over time? And another thing that's really important for us is, do they have some advantages in terms of distribution that go beyond open source? Do they have a community that already follows them through a newsletter or podcast or social media? This is incredibly important for the earliest stages, because open source businesses inherently require product-led growth. And so everything is around product and distribution and community very early. So it's nice to see some of these indicators with the open source founders that we work with.
So do you look for particularly founders who've built a strong personal brand before they start a startup? Is that something that is I imagine that would be an asset to a startup, is somebody with a large personal following.
Mm-hmm. It definitely can be an advantage for a founder. I think more than just having, first it starts with, you need to have domain expertise and technical aptitude in what you're building, because most open source sells into technical users, and you want to have the respect of the community that you're selling into, so that you can be a thought leader and help guide them along the journey of how technologies are evolving.
Okay.
Having the personal brand, in addition, that's wider scope beyond your immediate community, is really helpful for early distribution. And so it is a factor that we do consider when we're thinking about founders to partner with.
So I noticed that in your 4 buckets, team, product, market, money, for want of a better way of categorizing, the IPR regime, the fact that, your open source licensing, which license you've chosen, whether you have patents, those are not things that you mentioned. Are they things that are important as part of a funding decision?
Yeah, for us, of course, we go through legal diligence and trying to get a clear understanding of what the open source license is. It's less of a weighted concern, because pretty much every open source company we work with has already put a license program in place for them. So it's overall a consideration, but what we've seen recently is a lot of startups are actually changing their licenses as they evolve. So a great example of that is CockroachDB, that adopted a business source license, BSL, that allows customers and users to deploy their technologies. But if you are actually hosting it as a service provider, you need to pay them for that license. And so we've seen that trend with CockroachDB and a few others like Mongo and Elastic, who have adjusted their licenses over time.
So in general, those licensing trends, do you think that's something that is preponderant? Is it a trend that you can see, that you think will grow? Trends like the business supply license, the software, the server side public license, commons clause, basically the license writers or the license models that in some sense are not open source. I mean, they would not be OSI approved in general. Do you see that as a trend that is getting traction, or do you see that as something that's still relatively niche?
Yeah, I think we're going to see a growing trend of open source first startups making efforts to empower their end users to use the solution and get value from it, but then also protecting the work that they've done and really making sure that they're being given credit. Most of the time we see these adjustments and licenses a little later in a startup's life cycle, because at this point, often they're at a certain scale or visibility in the community, and they want to preserve that for future
Okay.
growth.
So it's like start with something like Apache v2 or GPL, LGPL, Mozilla, Eclipse, whatever the license happens to be. And then at some point in your growth trajectory, you say, okay, now we need to protect our investment.
I'm not suggesting that you shouldn't take the more conservative license earlier. I'm just saying historically what we've seen to date, because this is a more recent occurrence, is that these later stage businesses are making the license change. If you upfront think that BSL better fits your business and you are thinking long term, then that's a perfectly acceptable model.
Is license choice something that you would advise your companies on earlier in their life cycle?
It's definitely something that we talk about with founders all the time. We do lean to being thoughtful about which license you choose upfront. And if the license is through a structured organization like Apache, they have different governance around their projects. And so thinking about which license you adopt can actually influence how quickly you can deliver software, what is the process of community engagement and the standards you're held to. So yes, it is important to think about the license early in the business.
And I think, changing a license after it's been in place for a while can affect negatively community goodwill, right? People have feel like they've been engaging with you on one set of rules and then those rules change. Have you seen that?
Yeah, that's an angle. We don't really hear about that as much. And I think the change in licensees, as I mentioned with Elastic and Mongo and some of the other providers, demonstrate that, because it's still available for the end user. They're not really being that affected by the change. It's more about preservation of the business itself.
Okay. I was curious if you'd seen any negative impact, but I guess that answers that question. As an aside, in terms of the decisions during investment, one of the things that's been top of mind for a lot of people recently has been diversity in the investment community, diversity in open source, socioeconomic access to startup capital. Are those kind of criteria, geographical diversity, racial diversity, gender diversity in founders, are they criteria that come into consideration for you, or is that orthogonal to how you make decisions?
Well, of course, we deeply believe in the value of diversity for founding teams. At this point, there's great studies from like McKinsey and Harvard and Stanford showing that, teams that have diversity and are in the top quartile of diversity across organizations usually have better financial returns. I think it's like 35% better if it's ethnic and religious diversity, and about 15% better if it's gender diversity in the top quartile. And it's simply because diverse teams, cause each other to constantly re-examine the facts and remain objective. So it kind of pushes people to have higher levels of scrutiny of each other's actions and keep in mind alternative perspectives. Kind of breaking up that workplace homogeneity can lead to creativity and less bias, all things that we highly encourage. I would say that in our community over the past few years, there's been an increase in awareness of the value of diversity in founding teams or early operating partners. Personally, I'm very humbled to work with some great organizations like BC Open Door that works to empower those of diverse backgrounds to get access to capital and guidance, and All Raise that is more female focused with the same intent. Our team overall, I'm really proud to say that on the Redpoint early stage team, half of the investment professionals are women. It's pretty incredible. And it's a really good sign that when we are evaluating companies, we have different perspectives and can hear other sides of the story. And then I personally work with two female founders, Edith Harbaugh at Launch Darkly and Adit Levine at Solo.io, who are amazing technical founders that are truly trailblazers. What it really comes down to at the end of the day is diversity is definitely valued on teams, and we are highly supportive of people that are trying to go build something great regardless of background.
Yeah, I'm a big fan as well. I got to give a shout out to Backstage Capital from Ireland Hamilton, that invest a lot in minority and minorities. So yeah, thank you for that. And yeah, I actually meant to ask about there is a historic lack of diversity in the investment community as well, and obviously Redpoint is is it atypical having half of the investment partners be women?
It's starting to become more common that a larger portion of, diverse candidates are investment professionals on the team. I think, 50-50 is pretty darn good. Especially when Redpoint has such an emphasis on enterprise investing as well, which if you look at the different categories, there are fewer women who are enterprise investors like myself than maybe healthcare and consumer. So
Right.
I definitely applaud the founders of the firm and the leadership there for being very open-minded and thoughtful about what the future of an investor looks like. And as I said, I think that really reflects in the different types of founders that we back in both the open source community, but also some of the other sectors we spend time. And there is progress in our community, which is great. Like if you look at some of the numbers from 2020, the percentages of businesses that received their first check of financing, 20% had women as a co-founder in the business compared to only 10% about a decade before. So we are making good progress. Of course, can it be better? Are we making efforts? Yes, it's a journey, but I'm proud to be someone that is reflecting that more diverse background and being able to support other people like me on their journey.
So how do you get into venture capital? Do people come in through finance typically, or MBA background? Is there a different educational? Are there many paths into VC? Do people come in having been a founder first, or do people come in through M&A like yourself? Like how does one become a venture capitalist?
Yeah, it's an interesting role because there's no one path to becoming a venture capitalist by any means. There are a few more common ones, like a lot of people enter VC after working in product management or in senior leadership positions at startups. Another key path is actually being a founder and working with VCs and them, convincing you that, oh, you'd be great on the other side of the table. The third is through finance. That's a much more common path for growth investors because you need those technical financial skills for evaluating a business. And then fourth is through like MBA programs are a great source of talent for a lot of VCs.
Okay.
But there's no one way. It kind of depends on which role you're entering as and what the team is looking for.
And is it still dominated by kind of the Stanford, Harvard schools, or do you see people coming in from diverse geographical and educational backgrounds as well?
Yeah, I think the diversity is definitely increasing. Of what's really exciting about that is, I get to work with a lot of VCs that, are born abroad and are educated in their home countries at great universities and then transition to doing venture. With the new, hybrid reality of remote and centralized teams at startups and companies, you're starting to see a lot of people that are starting their own funds or solo GP capitalists within certain regions. And so they may have a particular diverse perspective because they're coming from a different part of the country than the coasts, a different perspective on what's valuable to their local community. So the diversity is definitely increasing. And while the traditional schools like Stanford and Harvard and MIT still have a presence, it's nice to see people of different backgrounds join as well.
So I guess something that you touch on is that the diversity in the investment community is directly related to where capital is going, right? And so if all of the capital is going to Silicon Valley companies, then you're going to have a preponderance of people who are from that area. But if you're seeing an investment and an increase in the geographical diversity of where companies are starting, then you see people who are underserved by capital. There's an opportunity for somebody to come in and say, well, I'm going to invest, $10 million in Detroit or.
Mm-hmm. Completely. Yeah. The distribution of where tech companies are being founded and headquarters is helping the diversity of the venture investors around them, right? So there's a great hubs of innovation in Indianapolis in the SaaS world, and there's local VCs there that may come from a different pedigree than some that you get on the coast. And that's all very encouraging.
Have you seen a big change this year with COVID and people staying at home in terms of, more geographically distributed companies, more companies being able to take advantage of cloud, software as a service models, basically divorcing where you're based from where your customers are based? Is that has this year changed things forever?
Yeah, I mean, it's a great question. 2020 was an anomalous year in so many different vectors. One thing that has been really interesting to see with founders, there's historically been a concentration of new startup creation in the Bay Area and New York and Seattle. And a lot of people did that because they were spinning out of a large tech company and they were already in the area, and it was really easy for them to hire friends and family to help bootstrap the company. And now with remote work, people are no longer as tied to the geography. They really get to choose the best place to live for them and their family and their interests. And we don't think we're going to go back to the world of, nearly 100% in person. We think it's going to be closer to 50-50. And that is definitely going to allow these founders to pick the geographies they want to live in, target early stage hires that may not be co-located with them, but are the best talent for their business. And as I said before, raise capital from maybe a more diverse audience of investors. Because at least from our perspective, a big shift that happened for us is moving to remote, and this video-enabled communication has allowed us as well to speak with more companies and founders across a wider geography than ever before.
But I guess that you would still, it's hard to overstate the importance of, serendipitous meetings at cafes and parties and being in the same area as a kind of a vibrant tech community, right? So even though we may see an evolution away from geographically located fixed companies to more diverse workforces, it's still, I imagine that you're still going to see a lot of investment decisions made by, you meet somebody in a social environment and then that leads to some kind of a business connection afterwards, right?
Yeah, ad hoc engagements have always been really present. Those will continue. I would say that I would imagine in the next year to 18 months, who knows beyond that, they're going to have less of an impact on investment decisions. Of course, an in-person relationship, often people feel more comfortable telling you about themselves and their business. But most of the investments we did this year were via Zoom, and we would meet people very considerately at the very end of processes or post-investment in person. We are not finding that the inability to meet in person if the team is in New York is hindering the opportunity to work with them. So you're right, happy hours, conferences, all of these things are still going to be important, but I think digital communication has enabled us to more equalize the playing field for those that may not be local.
So changing tack a little bit, are there so one of the questions that we see often is startups or open source projects wondering whether they should take a venture capital investment or not, whether such an investment will change their company for the worse or the better. So are there particular market segments? Are there particular business models? Are there particular types of projects that you would say are better suited to VC investments? How do you make those decisions from the investment side? And do you ever come across a company where you say, you really should be going for organic growth rather than trying to get into a more accelerated growth phase, and you really shouldn't be taking investment? You don't have the business model for it, the margins for it, the potential market growth for it. How do you figure out those kinds of questions?
Yeah, it's a great point. We don't believe every business needs to take venture capital money. Bootstrapping and reinvesting revenues for growth or taking debt are perfectly viable paths forward. If you decide to take venture capital, it's really important to think about three things. One is there a willingness to pay and pay significantly for what I'm offering if I am, providing something beyond open source, either services, a hardened enterprise instance, a hosted service. Two, am I operating in a really big market so that even if I get a little percentage of the customer base, I could still become a big company? Something that's interesting to think about is if there's an established market, like a database market or infrastructure management, configuration, provisioning, etc. We often find that if it's established with a closed source offering, an open source offering typically can capture 10 to 20% of what the closed source did. So if you are a founder and you're going after a small market that's serviced by a closed source offering, and then you can only capture a portion of that value, that's something very important to consider. And the third thing that is important to think about if you're actually going to found a business around open source is community and customer engagement. We often find there's amazing technical open source founders that build because they love it and they want to give back, but their goal is not really on the end user engagement side. And so for them, it doesn't come naturally helping users of their solution adopt it and grow and eventually monetize. So you also have to look at yourself as a founder. It's like, is this really what I want to be doing? Or do I really just want to build great projects that people value, but maybe they're in smaller markets, or I'm not really ever intending to monetize them?
Okay. Are there any, would you say it's better for B2B enterprise tools, developer tools, consumer SaaS? Are there specific things that aren't a good match for open source and specific things that are?
Yeah, historically, clearly, open source technologies have evolved into commercial B2B solutions. Think about Red Hat as, the largest open source company in the world. Do we see open source technologies selling to consumers? Yeah, it's actually been really cool over the past year in the note-taking space. There's been a lot of open source note-taking solutions like Athens and Foam that go after the end user, or even older VPN technologies that are open source, like OpenVPN, that go after the consumer. So I don't believe that consumers don't have appetite for open source, but once again, it goes into the size of the audience that you are addressing. They have to be technical, they have to know Git, they have to be willing to set up their own environments or servers. So it's just it shrinks your market, but can there be a really nice open source consumer business? I think some of the new ones we've started to see recently are good indicators of that.
It's one of the ones that surprised me when I learned was Waze had an open source client. Their mobile application was an open source application, but I think it surprised me because nobody ever builds their mobile application from source, right? You're getting it from the App Store. Why would you? But it was open source, and all of the value of Waze, of course, was in the data that was being created by the Waze community. So that's an example of a business that, the fact that the software itself was open source was in some sense orthogonal to, or relevant to their business model. Their business and growth model was around having a large number of people using, interacting with each other. There was a network effect. do you see data-driven business models being like, obviously it's growing, but is that something that you see a lot of open source projects taking advantage of, looking for a network effect in the user bases that they capture? And is it tough to monetize? So, like, how do you take advantage of that network effect and create a business model from it? Mm-hmm. It's a general question.
Yeah, most of the open source companies that we've come across or actually work with, they try to monetize a few different ways. We kind of alluded to it. One is in services, professional services, helping people get up and running with the technology. Two is offering more of the open core business model of having a lot of value in the open source project and then layering on enterprise functionality like SSO and authentication and management. And third is really in the providing a hosted service for people that love the technology but don't actually want to run it themselves. There are interesting aspects of a lot of projects that you're right. Is there economy of scale as more people use the hosted service? Do your gross margins go up? Do they actually have a better experience? Two, is there a way that the open source technology enables you to share and work more collaboratively with teammates, creating somewhat of a network effect or individual triggers in the product experience that causes you to expand use? And three, and I actually think is a huge component of this, that's starting to be really exciting, is does the open source project actually cause you to loop in non-technical users to it? There's some really cool innovations going on right now at applying open source to the application layer, which historically has been reserved for perpetual closed source license or a SaaS offering, but now we're starting to see SaaS companies being built on open source like Preset and Metabase, and those tools are actually not just touching technical users, but everyone across the organization as a BI solution. So there's definitely some cool things in terms of business models and the value of network effects and data moats to building a really good company in enterprise that is open source or not.
Okay. So can you walk me through, like, what does a typical investment experience look like from the startup point of view or from the fund point of view? Like, how long does it take to go from first contact to funding decision? How many meetings are involved? How laborious is the process, I guess? What does a typical experience look like?
Yeah, as we just talked about, how there's no one way to become a VC. There is no one way to get financing for your business. It definitely varies between sector, as I said, and stage. Typically on the early stage side where I focus, kind of pre-seed, seed, and Series A investing, they're usually more long-term. There's two forks. There's usually more long-term relationships with people who are operators who decide to transition out of their current role. Think about someone who was maybe the head of machine learning at Uber, who you've gotten to know, and then is going to commercialize some ML infrastructure solution. And so you've gotten to know them for years, you have conviction in them and people, and so those processes can be quite fast. They could be a few days to a week and culminate in a full partner meeting. The later you go, there is more work, at least on the VC side, of prepping and getting ready to recommend a recommendation. And so you're often speaking to customers because at that point they have them, speaking with experts in the industry about the long-term market trends, and then engaging the company in financial and professional diligence to have trust in the team. Those processes can be a little longer. Sometimes they're 2 weeks. Overall, the trend in our industry is everything is becoming faster. I remember when I joined Redpoint about 4 years ago, when we were processing a Series A, we typically have about 2 weeks. Now it's a few days to 1 week. Typically there's between 2 and 5 meetings with the founding team before we decide to lean forward. In the growth world, we equally had 2 to 3 week processes, and now it's sometimes a few days to a week. So things are moving much faster. My recommendation for founders would be to have all your materials ready at the point you want to start to have those conversations. So your pitch deck, your operating model, your pipeline of users or customers, because when a VC gets excited, given the competitive dynamics we're seeing now, they want to move fast. So the quicker that you can provide those materials, the faster you could probably get a term sheet. So it's a win for both.
So from first contact to term sheet in less than 2 weeks is not atypical.
Yes, it's no longer atypical.
That's crazy.
Yeah, things are moving really fast now. As I said, they can be shorter the more you know the founders, the earlier it is. And some of that is a function of relationship and check size. But there's definitely been processes I've been personally engaged with where it's a business we're excited about. We've done a whole bunch of research. We come with a prepared mind. We really know we want to work with the business already, and so it could be 24 to 48 hours.
Okay, so what kind of materials should a founder interested in taking investment, what kind of materials should they prepare? Like what are the essential elements of a pitch deck? How long should it be? What kind of financials will a VC look at for an early stage company?
Mm-hmm. Yeah, so a pitch deck usually has a few different segments that all are creating a story and narrative that's really supposed to convince the investor that they should work with you and give you capital. So it really starts with the pain point. What are you actually trying to solve for? Is this informed by your professional or life experience? Do you have an asymmetric insight that no one else sees but is incredibly valuable? So kind of the pain point, your solution, what makes it differentiated and special? Why does that actually matter to the customer? I think this is key. A lot of founders are like, oh, we're different because of X and Y. But then you have to think, do customers care? Do users care? Why does that actually matter to them? What is going to be so powerful about your differentiation that they're going to pick you over an alternative or rip something out they've already deployed? The third thing is talking about the competitive landscape and the market size. How big is the opportunity that you're going after? And then it usually ends with talking about the founding team. What is your expertise, your leadership history? Do you have a good ability to hire? And then concludes with talking about the traction in terms of users or revenue to date and the forecast for the business. And finally, the capital ask, how much are you raising? So that's kind of the flow of the pitch deck, something that I feel like founders often skip over, which is really surprising because when we're taught like persuasion techniques and writing in general, we're always told like provide a like hypothesis and thesis to your structure. And so the hypothesis in the pitch deck should really be like, you should invest in us for like X, Y, and Z. And the thesis is like, here, this is why you should give us money. And so it's been really surprising to me because I came from a academic background, research background, that people that are founders don't really always get that across in their pitch decks. And you want every investor you speak to consistently come away with the same thing about why your company. And so that could be as simple as we're going after the biggest market in the world. It's absolutely huge. Or I'm the domain expert and I'm very different in my technical capabilities, or some other factor. There needs to be at least one thing about your business, ideally multiple, that is absolutely differentiated from anything else and makes you shine and stand out. Because as you can imagine, we were just talking earlier about VCs are looking at more companies than ever before because teams are distributed and everything is video enabled now.
Right.
And founders are speaking to more VCs than ever before. The multiplication effect is, for us, we have to get a very clear, distilled thesis about why you as quickly into the conversation as possible, just as we in our role have to very clearly express why Redpoint, why Astasia Myers as quickly in the relationship as possible, because we want to be respectful of people's times. And there's only so much bandwidth. You really need to narrow down to who you're speaking with on both sides as quickly as possible.
And I imagine that just being open source is not a differentiator in itself, that
No, it's not.
that open source is just the way that you develop, and it is a tool for distribution, for maximizing distribution, but it is not a differentiating factor when you're thinking about the problem that you're solving for customers. Right?
Yeah, this is a great point that I think is not acknowledged enough. Is there's two different types of founders, right? There's the founder that created an open source project, maybe at their past business or as a hobby project because of their passion, then that later comes and says, you know what, like I think I can go build a business here. It's going to be incredible. The other founder path is I want to go create a company and I want to go offer a technology. At that point, you need to think about very seriously, why are you actually doing open source? Is it because it's a distribution model? Is it because it gets you into secure environments like financial services or healthcare, the federal government, like you wouldn't be able to do before? Is it because it's ease of implementation and versus commercial offerings? There has to be a really well understood reason that you're doing open source, because as I just mentioned, you're usually shrinking your total addressable market significantly by going open source. And two, there's not always a willingness to pay when you are open source. One of the key questions as a founder when you're doing your customer discovery, and we suggest you do at least 40 calls with potential buyers, is, hey, if I do open source, what would you pay for? How much would you pay for it? Who actually has the budget? These are all crucial questions. The worst case scenario you want to be in as an open source project is, hey, we are picking you as your startup's open source because you're cheap and you're free. And you don't unlock any additional user experience or functionality through being open source. I think that's one of the biggest learnings that we've had is it's a crucial question for founders to ask their customers and for us to ask during diligence processes. Because there's phenomenally popular open source projects out there that no one won't spend a dime on. And that's totally okay. They can continue to run, but it's probably not the best for a VC-backed business.
Yeah. Yeah. So you mentioned, it's a two-way conversation. Companies are selling themselves to Redpoint, and Redpoint is selling themselves to the company. So can you kind of, in general, give me a feel for what VC funds can bring to the table for early stage startups in terms of, the things that you offer, but also on the flip side, some of the things that you might ask of a company in return for an investment, say a leadership change position, board seats. What typically do companies give up in addition to equity when they partner with a venture capital firm?
Mm-hmm. Yeah, so we like to think about ourselves as more than just financial partners, but also operating partners of the business. There are more VCs than ever before, more angels and solo capitalists. So, all money is kind of green, and we don't think that's our differentiation and won't be going forward for most people in our position. And so what we really want to be is kind of the confidant and advisor to the business. So being the first call when things are good, but also more importantly, when things are bad, being a trusted ally where you can share what's really going on when things are awesome or, you need some help. And so with these founder journeys that have lots of up and downs, we like to be available 24/7 for our founders to help navigate this. And what we really like to do is, draw on our pattern matching capabilities, because we're in a very unique, special role of looking across many different businesses who have scaled and face different challenges and take those learnings into distilled pieces of feedback and guidance for the next group of companies that we work with. in addition to being that sounding board, we also have a portfolio founder experience team that helps with PR, marketing, and events, sales, pipeline development, and go-to-market feedback, and recruiting. We partner sometimes are the first check into the business very early, often, at least in my domain, deeply technical teams. And, we need to help them on their journey of being not just technology leaders, but business and startup leaders. And so that means surrounding them with advisors on the go-to-market side of the house. Often, we actually help them think through the go-to-market motion of the business, help them hire and recruit the initial go-to-market team, and then help them scale and up-level talent as they continue to grow. So it's a really holistic approach to working with founders. Each VC, I just kind of spoke a little bit about Redpoint. Each VC has a different emphasis on what they want to be known for in terms of their value add. But at least in our case, I think we really try to emphasize deep domain expertise. And this, because of that, our relationships with operators and talent in the community that we bring to bear to more quickly accelerate the growth of our startups.
I would be remiss. I mean, obviously, investing in startups is a risky business. Some startups that one invests in are not going to do well. So I'd be remiss if I didn't ask about, how does that experience work when you have an investment in a company that is not doing well? Do you try and head that off and help them through a pivot? What does that look like from your perspective, and then from the startup, the founder's perspective?
Yes, you're totally right. Not every business, unfortunately, becomes incredibly successful, and there are a few different paths forward for those that are not. One, a pivot. I think a great example of that is looking at Slack. They were a gaming company, pivoted into communication. We have a portfolio company, Lightstep, that was originally a social network that became a observability solution for developers. So, thinking creatively about new markets to go after. 2 is, of course, looking for an acquisition, or 3, spinning down the company. We are very founder first in our approach, and so really lean on what the founding team wants to do. In terms of the next stage of the business, for us, we are long-term investors, right? We want to maintain those relationships with people that we work with. Our reputation is crucial for our success as an individual or a team. And so not just in, continuing to support the founder, because they started it, they are the leader of this business for what they want to do, but I think it pays dividends in terms of how we're perceived in the market as well. For the founder, it is a very crucial choice for them. It can be very painful when you have to have a real conversation about how things are going, but frankly, often people are relieved. I don't envy that job. It's incredibly hard, and that's why we try to be great advisors to them, because they go through a very unique experience. And sometimes at the end, when they realize that they need to take an alternative path forward and may not be that unicorn or hyper growth business, it kind of eases them a little bit. And that acceptance can be really helpful for their wellness.
Okay. Do you ever find yourself in a position where a founder comes back looking for additional investment and you're like, I don't think this is a good idea?
There are definitely, most of the time, we, as I said, we are founder first, and whenever we're putting additional capital into the business, we do an agnostic reevaluation of it. We often bring in other team members who are not directly working with that company to kind of be an outside-in perspective of how the business is going to inform our decision. And yes, there are times where we believe that it is in the best interest to continue to support the business, and there are times when it's not in the best interest, probably for the team and for us, to continue to invest capital. Okay. And that's when we help do the guidance of what are the strategic options at this point in time.
So I have a couple of audience questions. What are your typical check sizes for Series A investments, and what criteria do you use to determine the size of the capital to commit? And when and why do you syndicate? And a second question, well, a third question, I guess, is what percentage of your meetings lead to term sheets?
That's a great, wow. Okay, so to go back to the first question, once again, this varies from VC firm to VC firm. Here at Redpoint, for a Series A, our average check size are somewhere between 5 and 15 million. We have the ability to flex up or flex down. We operate out of a $500 million fund, but we do have a minimum check into the business of about $1 million. At Redpoint, we typically lead when we partner with founders. So we, Dave, you were asking about this. We typically get a board seat as part of that. And, we try to shepherd the business all the way through acquisition and IPO with that. It's important and to check with any VC you partner with is how they think about pro rata and reserve funds. We, as I said, like to support founders through the life cycle of the business. So upfront, put away reserves to put in additional capital. Dave, can you repeat the other two questions real fast?
So there was, the question was, what criteria do you use to determine the size of the capital to commit? When and why do you syndicate? And what percentage of your meetings lead to term sheets?
So an idea about how much capital that we would invest in the business goes back to those 4 buckets: team, tech, market, and traction. We also look at industry benchmarks of what a typical business at this stage has been able to raise in the category to make sure it's fair for both parties. And then finally, there's this idea of the market clearing price, right? What is the market actually willing to pay, and do you agree with that? In terms of syndicates, as I said, we typically lead when we partner with founders working with pre-existing investors. We typically don't syndicate. We do it a little bit more at the seed stage, often working with great seed funds in a partnership role. And the third question is, what percentage of meetings do we have or meet with companies that go to term sheet? Gosh, that's such a good question. I actually ran those numbers last year for myself and kind of a few other people on our team. And just as I said, the distribution of companies that we speak with is increasing, and the number, and same with the founders meeting with VCs, has gone up. I met with 500 unique businesses last year, and an average person in my role will do 1 to 2 new investments every year. So
wow,
very, very low.
Okay.
Right? That's why we talked about thinking very thoughtfully about the structure of your pitch, driving to why you're special, what's amazing, and then the VC coming with their own angle, because the conversion is very, very low.
And so there's a 2-stage conversion, right? Founders meet with you first, and then you recommend a full partner meeting. Is that the way it works?
Yeah, it goes back and forth. It's a dialogue. Usually they meet with me first. I'm in a position to lead opportunities at Redpoint. And so they'll meet with me first. I'll usually start to engage with them, getting more details about the product and the customer and the traction. And then we take a team-based approach to investing. So I'll loop in other people who have spent time in the category, and then it will culminate in a full partner meeting. That's really important for us because we want the founder to feel comfortable emailing, picking up the call on anyone on the team, because we each have different core competencies we want to bring to bear for the founder.
Okay. I have this mental image of the full partner meeting looking a little bit like a Shark Tank episode where the founders come in with their pitch deck and do the presentation, and then there's Q&A. Is that the way it works, or am I... I've never been through one. But... Yeah.
It's I really don't want it to sound like it is Shark Tank, not at all. I mean, what's good is, at least for me and most of my peers, we really like to get to know people over time. And so I've probably spoken to the team a handful of times before bringing them to a full partner meeting, and they've met other teammates of mine along with the jury. So we don't try to make it as stark as like, oh, you're meeting strangers and now you're pitching and we're hammering you with questions, and then 10 minutes later, we do a vote, and it's much more, hey, I already know Astasia, I've already met some of her team members, it's mellow, we try to keep it fun and lighthearted, and ask, poignant questions that kind of move the needle in terms of our thought process, but
Okay.
yeah, definitely much more lightweight than the way TV shows are.
So before we wrap up, we're coming up on the end of the hour. Before we wrap up, I want to ask, what trends are you excited about right now? Where do you see open source going in the startup world over the next few years?
Mm-hmm. Well, I continue to think open source technologies will build very large companies. It's been absolutely incredibly exciting to see that the momentum in high-flying companies like CockroachDB and HashiCorp and Elastic and TimescaleDB over the past few years grow into what we know of them today. I think the frequency in which we see open source businesses becoming unicorns and publicly traded companies will only increase. There's a lot of great advantages of being open source, like the distribution, the lower customer acquisition costs, etc. So super pumped about all things open source. I think one big trend that I kind of alluded to, but we didn't dig much into, is the role of open source at the application layer. Historically, it's been mostly at infrastructure and security tooling, but now we're starting to see exciting projects like Preset and Metabase going after the app layer and being thoughtful about how they include designers as part of that open source community, something that has been not as important for the infrastructure players. And then in terms of broader key trends, as I said, I write about it a lot on Medium on my Memory Lake blog, but some things that I'm really into right now is the reimagining of the data infrastructure stack. We were very early investors in Snowflake and thinking about other adjacent markets that can benefit off of the role of data warehouses. And then another category I've been super keen on is actually tooling to help product-led growth companies be really successful. When you shift to product-led growth, the role of sales diminishes earlier in the business, and everything is about product centricity and user love. And the tooling that you need as a business to be successful there is quite different. The traditional CRM systems and marketing tools don't hold up as well. So looking at enabling technologies for these enterprise businesses.
Well, thank you very much for joining me today, Astasia. Next week, I am joined by Nithya Ruff, the head of the Open Source Program Office at Comcast, and Jill Yehuda, who is the head of open source for US Bank. And we're going to be talking about the role of open source program offices outside of the software industry. So this is a trend that we've seen across very large companies, across kind of stodgy, traditional industries like banking, telco, oil and gas, and elsewhere, that are creating these open source program offices to help structure the way they engage with and adopt open source. And I'm really looking forward to that topic. So you can see we've got a diversity of topics from early stage investor focused to kind of larger enterprise company focused. I'd like to thank you, Astasia, for joining me today. I'll be getting this episode up on YouTube later this week, and I will obviously share the link on Twitter as soon as I have that, and on LinkedIn. Thank you again for joining me. This has been a wonderful conversation.
Thanks so much for having me, Dave. This has been great. Really enjoyed it.
Goodbye.